Okay, let's get to some questions from the last market outlook. Quite a few of these I haven't read yet, so for many of them I'll be reading for the first time. Let's see. Thanks again for a great week on CRE. Obviously, ABR has plenty of exposure to this, albeit packaged up in non-recourse CLOs. I'm trying to imagine varying degrees of negative scenarios where many projects of the AFO unestablished multifamily residential portfolios experience stress. Given that ABR holds the lowest tranche and a certain amount of their values based on reputation, could you see significant downside to ABR? ABR always has significant downside whenever there's a credit issue, because that is their lifeblood, right? Is credit. So whenever money flows away from anything that has any credit risk in there, it doesn't make any judgments. It just flows away, which is fine. If there's more stress in the banking system and credit pulls back strongly to create a recession, another credit-led recession, could ABR find its way down to $7, $6, $5? Yeah, it could. But at that point, I would see that as a massive opportunity to load up. So there's a part of me that says, great. You have to have a recession scenario, and if a recession does happen, there are going to be some stocks that are going to be punished more than they should be. ABR will be one of those that will be punished more than it should be. So, it's on my list of things to watch, and, I'm sitting on cash, quite a bit of cash, more cash than I'd like to be sitting on right now. And if it does have, a bad couple of quarters, I'll take it. Regarding selling puts on TLT, what's the advantage of rolling up to 104 in May rather than rolling up to 104 closer expiration? I've been selling 7 data expiration puts on a weekly basis rather than using monthlies. Well, you can't get higher return without higher risk. So if you go on to say that you're getting more theta per day, yeah, you're getting more per day, which means you're taking on more risk somewhere else. So this is why I prefer 30 to 45 day options, and I'll look to roll them up at some point before expiration to avoid the high level of gamma, unless the underlying price is so far away from my strike. Why would I pay to close a bunch of options? At that point, I would just open up new options and leave the existing ones because my risk would be so low. But every 7 days, that's just not something I care to do. Just preference. It's a preference with the balance of risk. That's all it is. Let's see. Regarding money market funds, isn't this a lagging indicator? Well, you tell me. When somebody asks me a question like that, they may have an answer in their head that may be different than the answer I have in my head, and you're sort of asking me a question like I'm going to nod and say, yes, it is. But I may say, yes, it is because of a reason I have, which does not match the reason you have. And through no fault of my own, I'm verifying bad information. So whenever you say, isn't this a lagging indicator, or you ask somebody a question in a form that is a yes or no to an answer you have hidden in your head, it's always better to at least express why you think something is the way it is. Because I don't know why you think it is that. I've always thought that big investors would, let's say, sell equities and immediately deploy into money market funds. Well, if they're immediately deploying, wouldn't that then be a coincident indicator? If this is the case, should we have not seen a sharp sell-off in equities? Same for bonds. Well, money comes into the market all the time. Just think about the sheer amount of money every 2 weeks coming off of paychecks for defined benefit, defined contribution, pension plans, Social Security. That money flowing into Social Security has a broad portfolio of bonds, equities, etc. that invests in. So money every 2 weeks, with all the payroll deductions for pension contributions, flows in to pension funds, and then the sponsors then deploy that money into certain allocations. Well, If they say, well, let's increase our allocation to cash, then as that money comes in to the fund, they just don't deploy it to other managers. They just send it to money market funds. That's an easy decision to make. So you can have money flowing into money market funds without money coming out of anywhere else, simply because the money flowing in just doesn't flow into equities or doesn't flow into bonds. It just goes right into the money market accounts. So you don't necessarily need a sell-off for that. Also, large investors must be fully invested. So if you're invested in a small cap aggressive growth fund, that fund doesn't have the luxury of selling its equities and moving to cash. It must be fully invested at all times. It might have some amount of cash that it can play within, like 1% to 3% cash allocation. It may have something like that, but it typically must be fully invested. They typically have a benchmark, and their job is to beat the benchmark. So they overweight and underweight, but the luxury of moving all the cash and waiting something out is nothing that they can do. They must be fully invested all the time. So most large funds are not really the source of cash flowing into money market funds because they must be fully invested. Now, investors invested in that fund can pull their money out and move their money to money market funds, but the fund manager cannot make that decision on their own. They cannot move their allocation to money market funds within a small cap equity fund. They can't do that. Let's see. Going long TLT or ZB in order to add duration in anticipation of rates dropping, do you take into consideration that short end of the curve would drop more than long end? Well, I don't take it into consideration. That is exactly what will happen. My question is, how would you determine the optimal tenor to go long, given that longer maturities have higher duration but may not move as much as short tenors? Well, you're right. But let's take a 2-year tenor, and let's take a 30-year tenor. You'll have a duration here somewhere around 18. You'll have a duration here somewhere around probably 1.7, 1.8. So if you have a drop of 200 basis points here, since this is almost 10 times more in terms of duration, you only need a drop of 20 basis points to be the same thing. If the short end is dropping 200 basis points, I guarantee you the long end is dropping more than 20 basis points. So its duration is so much bigger that you don't really need that big of a move. So if this were the case here, every 100 basis points over here would only be, you'd only need maybe 9 or 10 basis points on the 30-year. Let's see. Okay, so would it make sense to calculate key rate duration? Not really. Key rate duration is the duration per each key rate. If you go to CME, you'll know what the cheapest to deliver is, and you'll have the duration of the cheapest to deliver. The duration of the cheapest to deliver is the duration of ZB, and same with the 2-year. You'll know what the cheapest to deliver is, and you'll be told what the duration, dollar duration, but you'd be told the duration of what the 2-year is. So you don't have to calculate key rates. You just have to calculate duration as per its tenor and its yield, which is given to you. If the free float of a company was registered directly in the name of shareholders, would the company need to issue more shares to restore liquidity? Huh? Registered directly in the name of the shareholder, would the company need to issue more shares to restore liquidity? I don't know what you're asking. Would this level of illiquidity be a potential contagion effect in the case of an oversized short position? What? Level of illiquidity contagion? What would be contagious? Contagion to where? Contagion to other stocks? In the case of an oversized short position, okay, I'm going to pass. I have no idea where you're going with this. I have no idea what that means. I'm going to pass on that. 82% probability of no hikes next meeting. Your view is aligned with the market as well. Inflation is still well above the 2% target, and the only tools they have to fight it are raising rates in hopes that it will reduce aggregate demand and withdrawing liquidity. Reducing balance sheet process clearly reversed on a dime. Whether we call this QE or something else matters little, thinks me. Well, what they're doing now is not QE. QE is actually buying bonds to change the yield. When you're just accepting bonds as collateral, none of that touches the market at all. So it's just providing liquidity to the banking sector and taking cash goods securities that may not be cash, may not have the par value today, but are all cash good, that if you held them, you'd be okay. So it's not QE in any sense, because it does not affect the market yield of any of the securities. If anything, it probably, well, I guess if the bank doesn't have to sell the securities and can pledge the securities for collateral, you could, in a sense, argue that, well, if the bank had to sell the securities, yields would go up with all the selling. I guess you could argue that. The inflation rate is still at 6%. Read a lot of work suggesting that the stationary mean of inflation has probably shifted higher. Could this possibly mean the inflation fight is lost? I don't think so. I mean, I think that we're going through a period of inflation that is sort of the, call it the afterbirth of all the shortages that we saw everywhere, and the economy will adjust to it. It happened too quickly and all at one time. It's difficult to adjust to that, but I do believe that given the level of technology that we have, that we are sort of in an inflationary environment against a backdrop of deflation, especially in countries that have very bad demographics, like Japan, like China, like the U.S. So no, I don't think the inflation fight is lost. And if hypothetically so, should the long end rise to compensate for that? Well, if that were the consensus, you would see the long end rise, yeah. Why do you think the term premium is still negative? I don't think the term premium is negative. I think that's still positive. I think what is pushing the long end of the curve down is a recession, is the idea of a recession, because nothing cures inflation like a recession. But the term premium, in terms of the maturity premium and the inflation expectation uncertainty premium, is always upward sloping and positive. Yeah, let's see. My question regarding selling puts, if one has a particular view on rates, inflation, and deficits, which prompts one to make a bullish bet on gold, expecting a significant repricing higher over the next 1 to 4 years. How would one most efficiently express that view? Buy gold. Would selling deep in the money 1.5 year out puts make sense? Well, on what though? What would you be selling puts on? Are you selling puts on GC, on futures? If you are, keep in mind that you're selling it on the curve. You're not selling it based on the current price today. So if you're going out 1.5 years and you're selling puts, you may be in a situation where, depending on the curve, let's say the curve looks like this, and there's $2,000 today, and you're going out 1.5 years and it's $1,850. That means you're selling puts on $1,850. You're not really selling it on $2,000. You're selling it, no matter how far out you go, you're selling it where on the curve you happen to be. If it's upward sloping and this is 2,100, you're selling puts at 2,100. You got to be careful what your underlying is. It's going to get on the futures, it's going to get very illiquid very fast on the curve. As soon as you go out more than, let's say, 2 contract months for the underlying, it's going to get illiquid very, very fast. So if you mean GC, the futures, you better know how to position yourself for that. And going out a year and a half probably isn't going to happen. Lots of illiquidity. Now, you may be able to get in, but if you got to get out, good luck getting out. The spread will be so wide, it'll be punishing to get out. So when you say 1 to 1.5 years out, on what? To play gold, you can play GLD, you can play the futures, you can play gold miners, or you can play a gold miner index. So it would be a matter of selling puts on what? Simply buy deep in the money, long dated calls. Again, it would be a matter of on what? Or what might be the best way to structure such a trade. To go out a year and a half and sell on the curve, you're probably better off finding maybe 2 months out, going 2 months out if you want to go long term that has some liquidity on the futures curve, selling puts on that, and just rolling your puts every 2 months, just rolling them forward every 60 days, or when you've made enough money on them, roll them forward. This allows you to also roll them up as well. So if the price of gold starts doing this, and you sold a put, let's say on downward sloping, if you had a backwardation, you sold a put a year and a half out at some low amount, and gold starts taking off, this is all you can make. That's it. Whereas if you sold 2 months out, right, and as it goes up, you roll forward and up. You roll forward and up each time. That might be a better way to express your view. If you have this view that it's going to have, you say, significant repricing. So if that's your view, then you'd probably want to be closer to the price so that you can roll forward and up. Will there be an archive for the Applied Series Q&A videos? No, there will not. Because there is a behavioral component to convenience. If you want individuals to get the most out of something, you cannot make it convenient. Here's what we've learned. I used to have years ago, I started something called office hours. We have office hours now, and they're well attended. When I first started office hours, I recorded them, and then I would make the replay available. So attendance for office hours was 0. There was nothing to record. There was nothing to replay. It was a waste of everybody's time. As soon as I stopped making it available for replay, I get more than 100 people at each session for office hours with lots of questions, 2.5, 3 hours long of just answering questions. And everybody benefits, and it's a better outcome for everybody. So if you make something so convenient that the decision not to go is a viable decision, most people will do that, thereby negating the very thing you set out to do. So it will not be archived, and that is only because if I do, the office hours would be a dismal failure. So to keep them good, I can't record them. Is there a specific reason for shorting SPY or ES instead of SPX? SPX is big, that's why. Also, SPX doesn't have the trading times that ES does. So for the options, I can Sunday night at 6 all the way to Friday at 5, 24 hours a day, except the 1 hour a day between 5 and 6 p.m. When CME flips over to the next day. They have that administrative hour where nothing trades, but it's just ES is just more liquid at all times. SPX is an index, so you can do options on SPX, but you have limited hours and they're not as liquid. So it's just a lot better with ES. SPY, shorting SPY is useful sometimes if you, especially when rates are high, if you want to create cash in your portfolio. So let's say I want to short ES. Well, I can go ahead and short ES. I neither get nor pay any American dollars to do that. It's free. in the sense that you don't really have to pay the other side anything, nor do you receive anything like you would with premiums on options. But when you short SPY at 395, if you short 100 shares, you get $39,500 into your account. And if your broker pays an interest rate, you can create, if I short 1,000 shares, I have $395,000, which means if I need to trade a pair, like USD MXN, for example, and I want to go short this, if I don't have any US dollars, I create a negative dollar position. So I can short SPY to create the US dollars required to go short this pair and turn these US dollars into Mexican pesos. And come up with US dollars if I don't have US dollars. So shorting SPY is a source of funds. If I need US dollars, I can short SPY. If I need, yen, I can short a Japanese stock, and I can come up with yen. So it's just a way to, it's useful in coming up with US dollars if you need US dollars. When interest rates were at like 0%, it didn't matter if you were short US dollars. The cost of being short US dollars was almost nothing, so who cared? But when it's over 4%, it does matter. 3 related questions. How is it possible that 1 month bills yield less than Fed funds rate? Just money rushing in, money going into money market securities, and the 1 month bill is a money market security. Money going in there is, that's what it'll do, because it's set by the forces of supply and demand. How should one decide how to position in the yield curve? Well, it depends on your view of what's going to happen where. So you may have a view that there are three big sort of ways to position. There's positioning for levels, which is duration. So if you think levels are on the curve are going to drop, you want to go as far out on the curve as you can and get duration. There is slope, which deals with the shape of the curve, whether the curve is going to flatten or steepen. So you can play curve flatteners and curve steepeners here. These are duration neutral, so that no matter if the curve goes up or down, it won't matter. All you care about is the curve steepening or flattening. And then there's a curvature trade, which is usually done with a butterfly trade. It's such a small thing, right? It's such a small thing. Levels usually make up almost about, I'd say, 85 to 90% of a fixed income return. 85 to 90. Slope is decent enough to play. It's a small part of the return, but because you're duration neutral, you lever it up 4 times, 5 times, 6 times. You can lever up slope, so you can actually get a decent return out of that. You are duration neutral, so you don't have to worry about levels. So whenever you can neutralize a big risk factor, you lever up. And then you just go from there, depending on what factor you're trying to play, level, slope, or curvature. Let's see. How should one decide how to position on inflation index versus nominal bonds? Look at the break even, and if you think inflation over the 5-year or 10-year period is going to come in higher, you go with tips. If you think it's going to come in lower, you go with nominal bonds. In relation to the point about having to roll over short-term debt to finance long-term assets when credit is tightening and getting more difficult, what alternative do companies have to try to match its duration risk? Well, they should have matched their asset and their liability to begin with. I mean, it is, I think, risk management 101 to say finance your short-term assets with short-term debt and finance your long-term assets with long-term debt. That's just, sort of risk management 101. However, if you have a central bank with a lot of credibility signaling that rates will be held low for an extended period of time, and you have an upward sloping yield curve, and you have a lender who is willing to lend you money for 1 year or 2 years, and willing to roll over that debt every so often to match a long-term asset, well, I mean, that's maximization of revenue. You're just using the capital structure and different maturities in your liabilities to maximize revenue. Although whenever you reach for yield, you also increase risk. You say derivatives use. Derivatives won't do it, because if my debt is due in a month and my bank says we're not going to roll over, it's like, well, what am I going to do? I mean, I can pay the interest, but I can't roll over the debt. I mean, I can't pay the maturity. I was relying on rolling over the debt. Now I'm going to have to sell the asset. Or move from a bank to a private lender and pay an even higher rate of interest. And basically, if I can't sell the asset, I got to take what I can get. I'll have to pay whatever it is that I have to pay. Well, that's going to squeeze my liquidity. My cash flow is going to go towards higher interest expense, and my margins have to suffer, and my income has to suffer. So the best way to get out of trouble is to not get into trouble. And if you're trying to make your earnings by getting fancy with your capital structure, the question then is, how come you're not doing with operations? I'm investing in your business because you say that you produce widgets. So I'm buying a widget producing company, and you should be making money based on your skill and expertise in making widgets. But if you're making your earnings per share by getting fancy with your capital structure that has nothing to do with the making of widgets, what am I really investing in? You know, obviously the widget making isn't as good as it should be, right? Let's see. How about if you raise capital through bonds? You can. And so will receive a lump sum cash from investors at some point in the future, but have payments due periodically within shorter time frames for your development project. What? How about if you raised capital through bonds, but have payments due periodically within shorter time frames for your development? I don't understand where you're going with that. If you raise capital through bonds and receive a lump sum cash from investors at some point in the future, why would you receive it in the future? If you sold bonds, you'd get it today. And you have payments due periodically within shorter time frames, but you have the money up front. Okay, so I don't understand your second paragraph. I'm going to pass. Retirement accounts and their lack of access to market tools. You essentially said it's not worth it until you're in a high tax bracket, which makes sense. In the U.S., we have Roth retirement accounts where you deposit post-tax dollars and distributions are tax-free. We have that in Canada. It's called the TFSA as well. I'm basically weighing current tax bracket versus future expected tax bracket and SPY returns versus a retail hedge fund style investing strategy. Some growth rates outweigh the tax benefit. I don't know what that means. I played around with some numbers, but I recall being surprised at how a small increase in return outweighed a large difference in tax brackets. Do you think this type of account would be super valuable even if it's restricted to holding spot? Yeah, I think you should maximize your tax-free savings account every single year, and just hold. It's tax-free, so your most take some inefficient type of return and stick it in your tax-free savings account. Typically, that would be growth stocks that pay a dividend. The higher the dividend payment that you get, the more likely you're going to want to hold it in your TFSA because you have the reinvestment of that dividend. The best thing to hold in your TFSA are value stocks that have a history of increasing their dividend over time, because you just keep reinvesting that dividend again and again and again, and you max out your TFSA and start early. And then everything that comes out of that later on is all tax-free. Thank you for the great content. Could you please go into detail why you chose the September underlying instead of the June underlying? What do you mean that the option expires in cash? So the option expires into the underlying futures contract, but the June futures contract expires at 9 a.m. Friday morning. The June option for June 16th that has the June futures contract as the underlying settles at the same time. So basically, when the option settles, I think the option settles the night before. The option settles the night before. You'll get this assigned to you, and then it's cash settled the next morning. Basically, it's timed, or I think there's about an hour difference. Anyways, this last option, because the expiration is so close to the expiration to the June contract, it basically is just expiring in cash. You're not really getting anything assigned to you for any period of time. But there is a June 16th option which has September contract as the underlying. So if it expires in June, you do have a contract that can be assigned to you all the way to the September expiration. What else we got here? Let's see. One part I found to be a little less complete was your commodity review, in particular oil. No mention of how inventory readings are trending. I have done that in past outlooks. Production forecast, future term structure. I've done that in past outlooks and in the applied series extras. So listen, every week I try to introduce something different, something new. So when I was first introducing oil, I was showing the curve, the futures curve, backwardation and contango. I was showing where you find the inventory reports, the production reports. And it is expected that that is something you then walk away with, as opposed to me doing it every single week. Otherwise, the market outlook would be 4 hours long every single week, every time I add something. So I revisit some things from time to time, but I don't revisit them from the bottom up every single time. The only things that I go through every single time are pretty much the rates. The first 3 screens are pretty much identical every time, because it's hard to understand where any other market is going unless you understand where the bond market is going. It's the market. Everything else is sort of just an extension of what's going on in the bond market. If we have an idea of where rates are, then you have an idea of what the discount rate is. And if you have an idea of what the discount rate is, then you know what present values of future cash flows are worth. Let's see. I understand how you calculate the projected price based on 30-year yield. However, my question is, what is the best comparison? Why not use the 20-year? I don't use the 20-year because if you look at the curve between the 10 and the 30, it does this at the 20-year because it has an odd clientele effect. So the 20-year is sort of out of place in terms of its yield. So if you're going to use something, either use the 10 or the 30. Since we're looking at TLT, the closest duration tenor is the 30-year. So it's not precise. It's not meant to be precise math. It's a neighborhood. It's what I call neighborhood math. You're in the neighborhood, and you know it's a close approximation. Can you explain the mechanics of why a narrow 10-year mortgage spread is better for mortgage REITs? Because mortgage REITs we know the relationship between yield and price, right? It looks like this. If this is price and this is yield, the lower the yield, the higher the price. So take a MBS security. Has 2 components. It has a risk-free component and it has the spread from the risk-free component to the yield on the MBS. And it's typically the 10-year plus some spread above that. An MREIT will buy mortgage-backed securities. But you could buy mortgage-backed securities, but what it will do is it will short a Treasury futures, the 10-year. So this is now hedged out. And this is isolated, and it isolates the spread. Then it brings significant leverage, 8 to 12 times leverage to the spread, which is something you probably would have a hard time getting done, building that structure. So it isolates just the spread. So if the spread drops, the price increases. And you've levered that up 8 to 12 times. So let's see, how How do the directional change affect if you're highly levered the spread? Well, I just showed you this is exactly what mortgage REITs do. About TLT yield, it appears to me that there's a gap between the corresponding capital market yield and the distribution. Why is that? Well, because it probably holds bonds with different coupons than what the market yield is, right? The market yield is a par yield. When you look at what the 30-year is yielding, if you see 3.64%, that is a par bond because the yield curve we look at is a par yield curve. That is if you buy a 30-year bond that is issued that day. If the par yield is 3.64 and the Treasury issues 30-year bonds, it'll sell them at par and it'll have a 3.64% coupon. If you buy an older 30-year bond with a 2% coupon, you're buying it at a discount, but the cash flow into TLT, into the fund that holds it, will be based on the 2% coupon, not the yield. So it is buying, whenever it buys a bond, it's going to buy at the yield based on what the constant maturity yield is for the 30-year, but it will make its yield on a combination of capital appreciating up to par over time, the bond being pulled to par over time, and a lower coupon. So its cash distributions are going to be based on the coupons it receives, and the coupons are probably more than likely, on average, lower than what the current par yield is. Is there a proxy for construction cost trends? A proxy for construction cost trends. PPI has a construction index. If you look in the PPI, there is a PPI for construction. Construction cost as an output. I'm thinking of mining companies that use mainly energy and capex to extract materials. Wouldn't that be an input then? Construction cost as an input. I'm thinking of general contractors that use the output of one to build warehouses. Okay, maybe I'm not following what you mean by output and input. Use the output to build warehouses and office. I work in real estate PE investment fund, and we always struggle to map the underlying trend of construction costs. Our main source of cost as we develop and sell quickly. It would be interesting to understand if general contractors are currently speculating, since 2 years ago their tenders with us have increased 300% costs, or if it is real that they are maintaining the same margins but increasing prices. Their inputs have increased due to mining companies increasing costs. Well, a mining company doesn't choose the price at which it sells its output. It is a commodity, and there is a price, a global price. There is a commodity price that it sells at, and that's what it sells at. So if you're looking for, hey, this guy's charging us more for copper, is this true? Just look at the price of copper. That's all you have to do. You don't have to think, well, are they how are they charging us more? Are they increasing their margin? You just look at the price of copper. So if you're looking at construction materials, there's the mining and materials. There are lots of mining and materials ETFs. The XME is a good one. Any commodity index is a good one. You're going to probably want one with a significant energy component in there, because the input, 35-40% of the input costs to extracting anything out of the ground is pure energy. So as energy costs go up, mining costs go up, but that does not mean the price of iron ore goes up. The price of iron ore could be dropping because, heck, there could be a surplus of it. And even though energy costs are going up, it just means the mining company is going to suffer in its margins. So if you're looking for exactly what the cost of everything is, just look at the price of it. It is a commodity. It is a global commodity. So copper is copper. Silver is silver. Gold is gold. Zinc is zinc. Nickel is nickel. You could just look at the price. So I don't know that that there has to be an index for that, unless I don't understand what you're asking. In which case I would direct you to PPI, because PPI does have a construction cost index. it measures input costs in the construction industry. Can you explain the relationship that exists between the 30-year fixed rate mortgage and 10-year treasury? Why would the 30-year fixed rate mortgage move more in sync with the 10-year? It's because their durations tend to be the same. They tend to be the same, have the same sensitivity according to price. So here's a 10-year, here's a 30-year, here's a 10-year bond with all its coupon payments and its final payment. Here's mortgage, right? There's a mortgage for 30 years. Notice it has no spike on the last payment. So this is called a bullet bond because it makes interest and then you have principal plus interest, whereas each payment here is principal plus interest. So for a 10-year bond, principal looks like this. For a fixed rate mortgage, principal kind of looks like this. So at any point in time, it's a lower and lower valued, call it bond, a lower and lower maturity value of the bond. So when you calculate the sensitivity of interest rates, since this last payment over here is always due, it's always going to have a huge amount of weight. But after each payment, there's less principal, less principal, less principal. So that means the full value of the mortgage keeps dropping and becomes, and as each month goes by, it becomes less and less sensitive to changes in interest rates. So it turns out that the sensitivity to changes in rates, which is what duration measures, these durations for the 10-year versus a fixed rate mortgage are fairly close. So that is why the mortgage rates tend to be pegged to the 10-year treasury, because they're just as sensitive, they're close to their sensitivities, and this becomes a natural hedging security against a fixed rate mortgage. How much hypothesis testing is actually used? Well, every time you run a regression, you use it, and you don't actually test. The output does it for you with the p-value, right? You have to understand the p-value, but are your coefficients significant? Your output will test it at 95%, which is typically the gold standard. Is your regression significant? Are your coefficients significant? So let's say you have B1, B2, B3, 3 independent variables in your regression, and you have a significant regression, but one of your coefficients are not significant. Well, you can create a more parsimonious model by using only 2 independent variables. And if you're paying for your data and now you only have to pay for 2 time series as opposed to 3, well then it saves you money, and it's a lot easier to work with when you're only working with 2 time series as opposed to 3 time series, right? So yeah, you do use it. But you're not going to break out your calculator and say, okay, this minus this over this, and then go to the tables and see if it's significant. Your p-value on your output, your p-value will be given. If you're running a regression and you want to test if the coefficient is different than 0, if you say, well, I'd rather know if it's different than 1, you can request that test. In like SAS or SPSS, you can request that test. You can request it to test different things. But unless you understand what hypothesis testing is, how hypothesis testing is done, just without knowing any of that, telling SPSS how to do it, you'll always be left wondering, well, what's it really doing? What is this thing called testing? What's this 95% thing? So when you learn it, you do learn it in a very, I guess, very simplified, basic way, but that you will never actually conduct the test yourself, but you should know how the test is done and what it's for, so that you know to ask the software to do the test for you, and then you understand what that number means when it gives it to you. Let's see. The only currency pairs you've mentioned, the yen, the peso, Canadian, except from Canadian. Why there is not a plethora of other pairs? Why? I mean, there's 5,000 stocks. I don't come anywhere near to mentioning 5,000 stocks. There's dozens of indexes, but I only talk about SPY. When you start getting into all these other pairs, the euro, the Swiss, well, I know nothing about the euro. How's it going to perform in a recession? I got no clue. None at all. It's just something I don't understand, and it moves because of its own reasons. And I guess if I were in the Eurozone, that would be the pair I would trade because I'd be more attuned to what's going on. But when you have like a whole bunch of currencies going on, you're going to be wrong on most of them because you can't. Currencies are a random walk to begin with. Some have some drift components. Some are better understood than others, but for the most part, they're random. Why would I want a portfolio of randomness? I have no insight into randomness. Not only that, in a recession, no matter how many currency pairs you have one bet. The US dollar. That's it. You got one bet. All your currencies will fall against the US dollar. I choose the peso because there is a good capital, foreign direct investment capital flow argument to a long-term strong peso. I choose the yen because it is on the other side of the world. And it is a safe haven for other currencies on the other side of the world. The US is a safe haven for currencies on this side of the world. And of course, I hedge out using the CAD. So I go for the big themes. The euro, I don't know, beats the hell out of me. The pound, no clue. No idea where that's going to go. There's just way too much going on. The story is not simple, it's complex. And I got no insight into it. There's the Russell 2000. There's ETFs for that. There's futures for that, but I don't play it at all because I just don't. It has a different beta. It has different types of exposures. So yeah, I get it. There's lots of currencies in the world, but I'm not a currency trader. Oh, I'll use currencies, but I'm not a currency trader. I'm primarily a macro top down with some bottom up stock picking involved, but I look for big themes that I understand. If I don't understand something, it's a general rule, I don't play it. If I don't understand it, I just stay the hell away from it. So somebody could say, have you seen stock ABC? And I could look at ABC and I could say, well, that's a pretty good chart. It's been going up for 20 years straight. But if I know nothing about ABC, no matter what dividend yield it has, no matter what kind of ratings it has, no matter what analysts say about it, I'm not playing it because I don't understand it. And if I don't understand it, it means I don't know what the risks are, which means I can't spot the risks coming before they show up because I don't know what would threaten a long position. So if I were long the euro, what's the threat to it? I don't know. Beats me. So I guess that's the simplest reason is just you can get really, really good at a few things, or you can be mediocre to poor at a whole bunch of things. And if you have a whole bunch of things and you don't understand what you have and they're all related to one risk factor, when that risk factor shows up, it's going to wipe out a whole bunch of your portfolio because you suddenly had all these correlated trades that you didn't think you had. I think if you're a currency trader and you're trying to play 10 or 15 currencies, you don't know what you're doing. I can tell you right now you don't know what you're doing because there is no possible way you could know that much about all those currencies. There's just no possible way that you could know all that. If you're a currency trader, you've typically got a small basket of currencies. 3 or 4, and that's really what you're playing with, is about 3 to 4, and you can do quite well with just 3 to 4 if that's what you're doing. But once you start getting 10, 12, 15 different pairs trading at the same time, you don't know what you're doing. How do you track average cost base for all your trades? I just let Interactive Brokers does it. I don't get too caught up in all of that stuff. If I'm trading, if I have a core position and I'm trading in and out, and I've got options either on calls or on puts, then yeah, I can track the average cost basis. It's easy to do in a spreadsheet. You just you just add them up and divide by the total. It's really not that hard to do, but for the most part, Interactive Brokers does it for me. And if you want to, you can change your tax lots. You can change your ACB to reflect first in, first out, or last in, first out. And if you're an active trader, use last in, first out. And this way here, if you buy a stock at, let's say 60, and you add it 58, and you add it 56, and it goes to 58, and you decide to sell, you had 100 shares each time, let's say, right? 100 shares each time, and you decide to sell at 58, it will say, okay, well, the 56 is gone. If you had 100 shares here, your average price is 58. I think you can see that. It takes this out and it changes your average price to 59 on the next 200 shares. So you can use first in, first out, last in, first out. If you are more concerned about tax efficiency when you sell at 58, you might want to use FIFO, which means it sells this at 58 and it assumes you paid 60, which gives you a $200 loss instead of a $200 gain. Right? And if it takes this out, then it makes your average price 57, and you're at 58 with a $200 unrealized gain. Same result. It is the same result. It's just which one goes to your tax form and which one stays as unrealized gain. Now, you can do this to track your ACB, but at the end of the year, the statement I get, it does not matter how I track my average cost basis. It says you bought X, you sold X. The difference between that is the gain that you realized, and you pay tax on that regardless of what you think you did. That's how it works. So being that it does that for tax purposes, at the end of the year, it really just doesn't matter how fancy you get with all this stuff. And at the end of the year, you get to December 31st, whatever open positions you have, these are the only things you have to adjust for. So you may have a position where you bought some stuff and sold some stuff and you have a loss, but that you then rebought that stuff, which means that you really aren't out of the stock. So that gain or that loss won't apply to you. So at the end of the year, you only have to adjust for the open positions that you have. And if you want to simplify your tax year as you get into the end of the year, simplify your portfolio. So I don't get too into detail about all those things. Sometimes you have to if you're really getting aggressive on the calls and puts, which means you're dealing in something that has high volatility, but you have some advantage, or you think you have some advantage because you feel a certain way. Then maybe I'll get more aggressive on tracking what my cost basis is. But for the most part, not so much. Par rates, break-even rates. I already gave you the video that explains what all those are. Just wondering, would you know where we can find information about some large institutions' strategic asset allocation info and their fund status, such as endowments and pension funds? Yeah, that's public information. A pension fund you should be able to Google the pension fund, and you should be able to find its IPS. And I mean, that's not hard to find. You can find all sorts of IPSs for foundations and endowments. Do you think retail traders can actually generate income in trading? I do. I do it all the time. For me, the market is one big giant money printing machine. It's when you know what you're doing, it's not hard to generate income with a low level of risk. Now, that may sound like I'm trying to sell you something, but I'm not. It's playing probabilities. If you knew that there was a coin that 90% of the time came up heads, 90% of the time you flip it and it comes up heads, would you start betting on it? $1 each time. You bet heads every time. You don't try to guess, you just bet heads all the time. Now, you're going to win on 90% of the tosses, but you're going to lose on 10. So 80, it'll net out to 80 wins. 90 wins, 10 losses is 80 wins, net wins, right? Well, that's what options are. Options play a probability distribution. And one thing we know about the probability distributions is the implied volatility distribution always tends to be greater than the historical volatility of the underlying. So right away I got an advantage. And a stock cannot both go up and down at the same time. So I got another advantage. So if I take the distribution of possible outcomes and I say, give me 10 delta over here, give me 10 delta over here, I got a 90% probability of profit, because the stock cannot both be here and here at the same time, right? And if I have 8 to 10 underlyings, which I feel are suitable for that kind of trading, I play the odds. I just play the odds, and if one works against me, well, then I take that one out of the equation, and then I go to loss prevention, which in the applied series, I show you how to minimize and even avoid a loss when something moves against you. So, can you generate income from trading? Yes, but if you're trying to generate income from trading by buying ABC, waiting for ABC to go up and then selling ABC and saying, okay, I made some money, now I'm going to buy XYZ, waiting for XYZ to go up, and then you sell XYZ and say, okay, I made some money. And that kind of rapid turnover, I know I've seen this, where you get a retail trader who'll buy 400 shares of something, and in a couple days it's up $1.20, and they go, I'm up $480 in 4 days, I'm going to sell that, now what? And they're looking for the next thing. That they think they can always catch something going up. They usually just blow up, because that is a very naive and brute force way to try to make money by doing nothing but capital gains. You have to find a way to generate your own income when you want to, in the size that you want it, for the day that you want it, and that's the options market. That is exactly what the options market does. Your biggest income traders are in the options market. I don't know how you can generate an income to provide, a way of life, a paycheck, without being in the options market. Unless you have a very large portfolio and you're a very good stock picker, and you feel you have an advantage over that, then yeah. You probably have a fund with other people's money in it too. To generate your own income, you need, with capital that you can provide yourself. I don't know how you can do it without options. And same with futures. You can do it well with futures, because futures are hugely capital efficient. And if you can find, different assets with different curves, you can trade carry off against each other, or work on positive carry. You can there's lots of trades where you're just making the carry. So yeah, I think it's possible, more than possible. I do it. I've been doing it for a long time. Currently student years level 3. Can you recommend me a structure on how I can get started with trading? The applied series, and go right to the applied options. Thinking about starting off with your applied series. Oh, there it is. I don't know much about technical analysis. Ignore that. Ignore technical analysis. I started by putting some of the technical analysis readings in there, but I lost patience with it. I mean, it starts getting into stuff where I thought, okay, this is just a big pile of horseshit, and I cannot in good conscience teach it like it's real. It's just a pile of horseshit. Ignore technical analysis. There was a note by Goldman Sachs on oil last week claiming that one of the reasons for lower oil prices in the past week is negative gamma. Is that something you could elaborate, please? No, I didn't read the note, so I don't know exactly what their argument was. But when you get close to the expiration of one contract and you're moving into another contract, there is something called the roll, where everyone gets out of one contract to get into the next contract. So if you're long the front contract and you have to roll your contract. You have to sell that one, and buy the back one or the back second one. So if you go to CME, there is something called the pace of the roll. Pace of the roll. And it will show you, and it's got this neat little graph that shows you, the bands over which you'd normally expect to see the pace of the roll, so that if it's happening faster, if it's happening slower, you could start to say, okay, well, if it's going too fast, it might explain some price movement. If it's going too slow, then you're going to expect some kind of major price movement before expiration. But it's very common that this is, let's say, 100% of the positions, 0% of the positions. Here's the expiration date of the contract before the delivery period. This is the delivery period. Well, the closer you get to the delivery period, you get this roll that happens. So have a look at pace of the roll, or Google pace of the roll. That might be in line with what he was explaining. What do you think is driving AR's price movement relative to its peers? Well, I mean, that short seller report, I'm giving them credit by calling it a short seller report. That scam report is going to affect some people's thinking, so let it. But whenever there's credit worries, credit sensitive stocks like ABR do sell off, and it is an overreaction, and I love it when something like that happens. So ABR, Agency, Annaly, I'd love to see them all under $5. I would love it, because I would back up the truck and load up on those. Would you mind expounding on your relative bear case for REITs? Well, REITs have debt, right? And that debt comes due. There are mortgages, and mortgages come due, and you have to extend. You have to roll over, because REITs, they don't have retained earnings, right? 90% of the taxable income must be paid out in dividends. So they don't retain a lot of cash. So they rely on refinancing their mortgages, or they rely on selling their assets and retiring debt. So they may buy a building at $20 million. 5 years later, they sell it at $27 million because they've raised the net operating income of the property. Then they may buy another $20 million property with it that has lower occupancy that they can upgrade, and they'll take the $7 million to retire debt and finance the other building at a lower price. So they're always rolling over debt to some degree. Well, what if you can't? And what if you can't sell commercial real estate? What if the buyers in that market dry up? You can't sell it, and you can't roll over, right? You what are you going to do? So it is, I think, a problem. And for apartment REITs, the reason I'm not bearish on apartment REITs, I'm no longer bullish. So let's take a building. And we'll try to draw it out as best we can with my Masters of Fine Arts degree, and we'll put a chimney on that because it's one of those really nice places, and a nice little winding walkway with a fence around it. Okay, it's a building, so it has multiple apartments. There we go. Good. And there's a whole bunch of them in a community. There, I took a lot of time drawing that out. So let's say that I upgrade all the units. And let's say that I raise the rent on all the units, and I'm running at 99% occupancy. Where's my growth going to come from? I can't rent out any more units. They're almost all rented. My rents are at or near market rents right now, so my upside is rather limited. For the apartments that are below market rent, they're just not turning over, because when rents go up, you don't have the occupancy turnover that you want. So I can't, when somebody moves out, I can't go in, upgrade the unit, and charge 20-30% more rent, because I've upgraded them all. So once I've squeezed all the efficiency I can out of that building, where's my growth in NOI going to come from? So when you buy a building that has 80% occupancy, and the units are dated, you can have NOI that does this for a period of time. But the closer you get to being finished and full occupancy, your NOI starts to do this. Well, there's the sweet spot. This is, where's that kind of growth? It just Where are you going to go with that? So I'm not bullish on apartment REITs because, well, they've squeezed everything they can out of the market. They're not doing bad, but where's the upside, right? So that's why I'm not bullish on that. For retail and office, well, office has its own problems in rising occupancy rates, and retail, there's just too much retail to begin with. So being that all commercial real estate is going to suffer, even if it's just office and retail, the whole sector will get thrown out. Why be in the sector at all? At some point, I think getting back into them will be appropriate, but when the cap rates are, on A properties, when you see cap rates at 8 to 10% instead of 4 to 5%, that might make sense. But cap rates have got to get back to something realistic. They're just still too low. On point with Canadian real estate. Canadian RA, especially in Vancouver, is not going to crash. If you think it is, you better talk to the hundreds of people coming to open houses right now. That's just a statement. I realized, Koifin, that some sectors such as semiconductor, software, and solar outperformed S&P by a wide margin in 5 and 10 year windows. Yeah. You see triggers so they keep outperforming? Well, I don't know. I've never followed semiconductors at all. Software is, as a class, I've never really followed that either. So, do you see triggers to keep outperforming in line with what you see the case? Miners, I understand the case very well. Home builders, I understand the case very well. I don't understand the case for software. What software? What industry? If you're talking about AI, it's already overvalued. It's already overvalued because everyone's talking about it and everybody wants in and everyone's rushing the market with their own AI. It's already overvalued. AI won't be investable for another 4 or 5 years at a reasonable price. You can get in now, but it's already overpriced. So I don't like doing that kind of stuff. But I can see the case for miners and home builders very clearly from a macro perspective. But from a macro perspective, I don't get the rest because I just don't understand their industries. I listened 2 times to your TLT calculation, but I could not quite follow it. It's not a big deal. Do you mind re-explaining your calculation? Well, it's just an empirical calculation. It's just looking at, if you have a portfolio of bonds, which that's all TLT is a portfolio of bonds. If you have the portfolio changed by 8%, and the duration of the portfolio of bonds, you can calculate what the change in yield was for the portfolio. And if you can calculate what the change in yield was, you should be able to come up with a target price. I think it showed you, call it 8%. It was up 8%. We know that the duration is 17.6. So we can calculate the change in yield that happened given a duration of 17.6 that ended with 8%. And if you can do that and the stock is at 106 and you think it's going to go to 130, well, what percentage change in that? That is that. You already know duration, so you can calculate the change in yield necessary to get to that, right? All this thing here is percentage change in the present value is equal to negative modified duration times the change in yield. Remember that from level 1, right? Well, that's that. Solve for one unknown. That's all I did is I solved for one unknown. And then to get a target price of 130, you just calculate, well, what's the percentage change here? That's that. What's the duration? That's that. Solve for one unknown. That's all I did. Earnings season just around the corner. Wondering if you could go through setting up a volatility crush trade. I know you have a video in the applied options series on options volatility, but would be valuable to go through setting one up. Why? That's risky, right? It's risky, and these things work in numbers, which means, most of the time, because the volatility of the move is priced in before earnings, most underlying prices do not exceed the straddle. So if you have a stock that's at $80 and you sell the straddle, which means you're short the call, you're short the put at a strike of 80 bucks, the implied volatility will increase up to the point of earnings. So if earnings are after the close, you want to put your trade on at like 3:55 p.m., 3:55 to 4 o'clock. In those last 5 minutes, you want to get as close to the closing price as possible, because all of the expected volatility will be priced into the call and the put. And then when earnings come out, as long as it stays within the break-even point, because you add these two up and then you have your lower and upper break-evens on this, as long as it stays within there, all of that volatility that went in there will drop very quickly. That's called volatility crush, and you could do very well. However, if you're wrong and a stock misses earnings and it plummets, you get crushed. So volatility crush will crush two ways. Number one, the payoff is because of the volatility crush. Number two, if you're wrong, you get crushed because the options no longer trade after hours on the underlying, which means you got to wait till 9:30 the next morning to get out of that. Good luck sleeping. This will keep you up all night. It's dangerous to play because you can't hedge out, because you're doing this before the market closes, and you cannot do anything until the market opens. And between the close and the open, you're getting earnings. Now, if earnings are bad, or the guidance is bad in Q1, when we get into April, you could get hurt a lot on the puts. You could get hurt a lot. But if you say, well, okay, I'll just sell calls then, well, what if something really hits? Then you can get hurt a lot. That's gambling. All this is, playing the volatility crush, is simply just gambling. I don't gamble. So I don't know that I would have anything that I would recommend on that. Your investment thesis for agency. Well, these are government guaranteed mortgages. Basically, they're issued by government sponsored entities. They're called agency mortgages. They have a de facto government guarantee. No credit risk. It's just spread risk. That's all it is. The interest rate risk is hedged out as much as they possibly can, so I have spread risk. Well, spreads will widen, and then spreads will decrease. I'm not concerned. I'm unconcerned. You said short put and buy out of the money, LTL call to long the duration. Do you also use bond futures? Yeah, I can. Is buy and hold bond futures a good strategy until rates fall? Yeah, I think it is. I think today gave us a good opportunity if you wanted to sell puts on TLT or to buy bond futures. I think the pullback today gave us a good opportunity. At most, there's one rate hike left. At most, I'm skeptical. But at most, there's one, which means the downside on ZB, the downside on TLT at this point, I believe, is limited. Is limited based on rate hikes. Yeah, I think it's limited. So, yeah, you could buy ZB, but you have to roll over your futures. If you're long TLT, well, you could buy and hold. But with ZB, you have to continually roll over your futures. You mentioned Howard Marks was an investor worth looking up. Could you broadly describe what his main points are and whether his, somebody answered you that you could just Google that. Go to YouTube, type in Howard Marks, and he's got a whole bunch of different interviews, and his message is almost the same in every interview. He's big on cycles. He's a cycle guy. Big on cycles, but not technical analysis cycles. I mean big fundamental cycles. So he's easy to understand. You can pick up what he's saying very quickly, and I think he's worth listening to. What is a good way to estimate how much money is sitting on the sidelines in cash at any given point in the market? Well, you can look at how much money is in money market funds versus how much money normally is in money market funds. So if there's, in good times, money market funds hold about $2 trillion. You could say, okay, well, that $2 trillion is not on the sidelines. That $2 trillion is money market funds. Just because I'm in a money market fund doesn't mean I'm on the sidelines. It just could mean that that's where I want to be. So we're at a little over 5 trillion now. I'm just saying, what if it is 2 trillion? Then you can estimate that there's 3 trillion, but you don't know where that money belongs. Does it belong to the bond market or does it belong to the equity market? More than likely, a large part of that money market balance belongs to the bond market, I should say, and doesn't really belong to the equity market. Some of it may even belong to the banks, in the sense that people took money out of the bank to stick in the money market fund because they're getting a higher yield, and if they got a lower yield, they'd take it out and put it back in the bank. So it doesn't necessarily mean that all the money on the sideline belongs to the equity market. How do you manage your exposure to iron ore? I answered this last week. Do you think the cash flow one can get from REITs may justify staying invested for the long term, especially those related to industries' long-term growth specs such as industrials? Well, listen, when the market throws out a sector, it doesn't distinguish. It throws out the whole sector. It doesn't distinguish. So if a REIT has a dividend of 5%, what if it drops 20%? Wouldn't it be better just to hang out on the sidelines and wait for it to drop 10 or 15 or 20%? If you decide to buy a REIT today at $100 and it pays a 4% dividend, and you wait a couple of weeks and it drops to 96 and you buy it at 96, you've in essence made 1 year's dividend just by waiting 2 weeks, right? Every 4% is 1 year's dividend that you just made. Actually, it's probably 2 years dividend, because REITs don't pay qualified dividends. The income on REITs is full income. I got a 53% tax bracket, so the REIT can drop $2, and for me, that's 1 year's dividend after tax. I'm indifferent, so why not sell a put at $95, right? Why jump into it? If the sector is going to be out of favor, commercial real estate, I can tell you that the market will make no distinction. It will throw the good out with the bad. So if you know what's good, then you just hang around and wait to pick up the good. It will get thrown out. Do you mind including actual earnings for S&P 500 on your screen to forward earnings? Well, actual earnings are reported by S&P Global in that spreadsheet. So you will get actual earnings. I don't really have to put it on the screen. Actual earnings are historical. When we buy something in the market, we buy the future. We always buy the future. Actual earnings are historical. They matter little. Actual earnings could look fantastic and the market could be selling off hard because guidance sucks. It's all about what's going to happen tomorrow, not what you did in the past. What happened to put for stock that was sold on hold, like SVB and gone bankrupt? Well, then the puts, nothing would be, if you had sold puts, basically you got to pay the other side everything. You basically are out the whole amount. Like a stock gone to zero? Yep, like a stock gone to zero. You have any advice on managing, minimizing taxes when exiting or reducing exposure to holding with significant capital gains? Well, if you're exiting a position with significant capital gains, there's not much you can do other than just say, well, I guess I got to pay tax. At that point, I would say, look at your portfolio. Look at some of the things are you holding that are underwater. Are you holding them based on hope? Because if you're holding them based on hope, now's the time to take the loss, because you just took a big gain. Otherwise, you're going to have to pay tax, and you're still holding something that owes you money on hope. So whenever you have big gains, that's the time to probably think about retiring some hope. You know, you've held that one stock. It's a year and a half now. It's still underwater. It's not, maybe it's not coming back, but it's been a year and a half and all the hope hasn't done anything. It might be time to just take the loss, right? Expand on your reasoning as to why you sell 5 futures contracts and 5 calls on futures instead of 10 futures contracts directly. It's just to have a sort of a mix. Like, so you can sell 10, but think about it in terms of delta. You have 10 times a delta of 1 as opposed to a delta of 5 and then 5 other securities with lower deltas with some convexity, albeit negative convexity. It's if you're wrong, then you do have some margin on the upside to protect you. It just I don't know. It's just a preference I have. It's just to diversify across the either have some holdings that are linear, some that are non-linear, some that are convex. Again, even though it's negative convexity, it's still convex. And if I'm wrong, I have all of the premium as protection. So let's say that I sell a ES at where are we sitting now? 40.40. I think at the close it was 40.40. That's September ES. So I can short a September ES at 40.40, and I think there's about, what's the underlying, 39.60. There's about 80 points of carry in there. So I got 80 points of carry. If I sell a 40.50 call, let's say for June 16th expiration, and I get 195 for it, there's another 195 points above the 40.50, which is already 80 points above the underlying. That's huge protection, right? That means I've got all the way up to 42.45 before these things start losing money, but this will lose money, point for point all the way up. So it's just a matter of how I feel and what I want to do. It doesn't matter how I get my delta. Let's say that I want the equivalent of being short 300 ES. I want the equivalent of that. Well, it wouldn't matter if I were short 150 ES and 300 calls with a delta of 0.5. I'd still have the equivalent of 300. And as the market starts dropping, I got 150 dropping. Now, the delta on these will drop to 0.4, 0.3, but I can continually roll these down. It just gives me upside protection, and I can always rebalance to 300 by rolling them down. I don't know. Just flexibility, I guess. Let's see. Are there any other sectors, industries that you could see breaking next due to interest rate increases or due to financial institution tightening credit? Well, credit can hurt almost anybody. About a month ago, I showed you an auto parts supplier called Stanadyne that was broken because of credit. So credit can break any company that has a capital structure that is a little too heavy on debt, and especially debt that is further and further away from the public markets. You go to public markets, you'll get the cheapest kind of lending. You go to banks, it'll be more expensive. You go from banks into the private credit, it's going to be even more expensive. So it can hurt any company, but I don't know that would be systemic. I don't know that any company in any industry, even if there were, same with commercial real estate, I don't see that would be systemic. I think that would affect commercial real estate. But credit, as soon as you turn off credit, that affects everybody. That affects everybody immediately. And it only takes days before companies start falling, because you want to destroy a company, take away its liquidity. Take away its liquidity really fast, and you can destroy a company really fast. You're suggesting rates higher and unemployment higher happen at the same time. No. I demonstrated that as rates went up, unemployment went down. So no, I didn't explain these two things. Why the money market rates is less than 50? Okay, I already explained that. Do I hear you correctly that if we think there'll be a recession, oil should be lower moving forward, so this would not be a good time to go long oil? Yeah, energy is a tough one. Oil is sensitive to economic growth. If you have a recession, oil will go down. If you were to go long later in the cycle, what are some of the preferred ways you would do that? I don't play oil. I used to, until you lose once, and oil is just big, and it moves fast, and it hurts. I guess you can use QM. QM is for 500 barrels of oil instead of 1,000. CL is for 1,000 barrels of oil, so every dollar is $1,000. USO, which is an ETF that tracks oil, you can use that. You can use oil companies, Oxy, for example. Warren Buffett just this last week bought even more shares of Oxy. So, there's lots of ways to play oil. You can play the companies, you can play the futures, you could play the ETFs. Nothing cures inflation like a recession. This is true. However, if you look at past recessions, it doesn't bring it down to zero. It does. It brings it to below zero. Maybe reduce it by 30 to 40%. So from underlying rates of 4.5 to 3. But that isn't 2. No, it crushes inflation. I'm not sure where you're getting this information. So I'm going to pass on the rest of the statement because this is wrong information. I'm not sure where you're getting that. I'm seeing many people agree with your line of thought in the bond market. We'll have to cut rates regardless. In the past, the Fed was able to cut so aggressively because their funds rate was so far above the rate of inflation. No, I don't agree with that either. No, in 2007, inflation was running 5.6%. The overnight rate was 5.25. So I don't know where you're getting your data. I'll pass on the question. Minsky moment. Do you think a private equity short could be a good idea? Well, no, I don't think it would be a good idea. I don't, which private equity fund? Why private equity specifically? If issues related to debt rollover are realized further in the industry. Well, I know private equity uses leverage. They do use private debt. So, if they buy a company for 10 million, they'll put in 5 and they'll leverage the other 5. And then the cash flow from the target company pays down the debt, which leverages up their equity. I know they do that. But usually the targets have fairly good cash flows. It would be hard to pick which private equity fund. You'd have to know about their portfolio companies, the cash flow from their portfolio companies, the margins. You're just not going to know that information. So it would be a tough one to guess. Here's the thing. If there's a credit problem, there is only one short, and that's SPY. Everything else will be correlated. Correlations will move to 1 and everything will drop. So it's not a matter of saying, let's short the market. What else can we short? If you're expecting a credit crisis and a recession, there is only one short, and that's the market. And there is only one long, and that's duration. That's it. So you can think of targets, or you could just think of factors. If you say, well, I'm going to short industry A, I'm going to short industry B, I'm going to short industry C. Well, all of these have beta. Just be short beta, right? You say, well, I'm going to go long TLT, I'm going to go long ZB, I'm going to buy some bonds. Well, this is all the same thing, duration. Just go long duration. Don't get fancy. If you think that the market is going to experience a credit crunch and companies are going to be in trouble, why search for all the idiosyncratic sectors and companies to short? Just be short beta. Be short beta at the highest level. Now you have a diversified beta short. You have the whole market, and you have a diversified duration long. I wouldn't start looking in little corners to see what else I could short. I know it sounds exciting to look at your portfolio and say, well, I'm long this and long that, short these things, I got these options, these currencies, I got this over here. It makes it look like you're, worldly in that sense, but oftentimes the best strategies are the simplest strategies. So in the market outlook on Sunday, I said that, I think IYR finds its way into the 50s. It's sitting at about $80 right now. I think 55 to Well, 55 down to $50 makes sense on IYR, but I will not short IYR because what gets it there is short beta. Why not just be short the market? When the market's dropping, correlations tend to move to 1 on anything that has beta exposure. So why have 10 different trades in which the correlations will move to 1 such that you have one trade? Why not just keep it simple and have one trade? If you have one trade and you're wrong, risk management on one position is a lot easier than risk management on 10 positions. Okay. Do you think technological innovations in the U.S. with the main purpose of easing labor requirements of corporations is the best use of time and resources? Well, you're going to have to do something. You can't count on immigration because your elected officials aren't going to do a damn thing. Write them off. You could just write them off. They're a cost. They are a cost of having a country. In a democracy, your government is simply a cost of having a country. They are not a benefit to the country. They are a cost of having the country. You write them off. They're not going to solve the problem. If we have a labor shortage, do not look to Congress to solve the labor shortage. Look to companies to solve the labor shortage. So yes, I think you're right. Wouldn't there be more meaningful innovations if the U.S. had more permissive immigration system? Well, no. If I have a whole pool of low-skilled labor, where is my motivation to eliminate them? I mean, they're cheap. Why would I eliminate them? But if I have a McDonald's and you force me to pay $20 an hour, I tell you, I'm going to automate as quickly as you could possibly imagine. I'm going to automate fast because now I'm eliminating $20,000. Each worker's worth what, with all taxes in and everything, $45,000. So if I can eliminate 10 workers with an investment of $250,000 in technology, I eliminate $450,000 in wages. The higher the wages goes, especially for unskilled or low-skilled work, I am going to automate fast. So the more immigration, the lower wages are. Well, why would I spend money to eliminate something that's cheap already, right? You mentioned you bought shares of agency. Just wondering what your thought process is going long the stock instead of doing synthetic long using options. I bought agency in my registered account. So yeah, in my taxable account, I would do a synthetic. But I bought it in my registered account. If you recall, a couple weeks ago, I said that I am now out of all my REITs. Well, most of my REITs, well, I shouldn't say most. Most of my retirement accounts held REITs. So now I'm sitting in cash. So I'm buying agency. Isn't market expecting rate pause fighting the Fed? Oh, isn't the market expecting a rate pause fighting Fed? No, I think the Fed is pretty much on that page. From their last statement, the change in language is sort of telegraphing that it is possible to expect no hike or even just one hike left. And the dot plot shows that they have 10 basis points in hikes left, which you can call it one. Even the dot plot is saying there's really only one left. So Camden Property Trust is trading around 7% cap rate. Is my understanding that between 5 and 10 is attractive. Do you think it still holds true, or is it cheap? Can get cheaper scenario? I think we're in a cheap can get cheaper scenario. If this banking crisis isn't over, if there's even a hint of it showing up somewhere, even if you get one more bank anywhere in the globe, a big enough bank in a country anywhere in the globe that has trouble, it's going to cast a big shadow on everything, and credit will dry up really quick. Which means, yeah, cheap can get cheaper. What are your thoughts about the tech rally? Don't really have any thoughts about it. How to interpret CVOL? I guess you'd interpret. I'm always troubled by this. How do you interpret it? If I see volatility higher, I interpret it as volatility higher. I don't know that there's much interpretation to put into that. It's just there's more volatility. That's what it means. So I don't know that there's some kind of trick or something, something that oh, because it's high, it means this, and if it means that, and you draw a line to this, and it means that, it means this over. I don't think it's just as directed as it is. CVol is just measuring the volatility in either price or yield, depending on how you want to look at it. What would be your advice to a person who passed level 3 but cannot find a job? Then it's got to be something about your resume that is the stumbling block there. It's got to be something about your resume. What are your views on the high immigration in Canada in terms of growth for the economy? It's not translating into growth for the economy. If to put it bluntly, it's not. The budget that came out today, the expectation built into the budget was 0.3% real GDP growth for this year. And over the last year, we have 1 million more people, and all we can squeeze out is 0.3% real GDP growth. So it's not translating into growth. So I don't really know. You got me on that one. Canada's always had this problem. We seem to have, we look at the numbers in terms of immigration, but it doesn't really translate into a lot of growth. It doesn't translate into a lot of productivity. In fact, we've had this thing called the productivity puzzle for years and years and years, is how come our productivity in Canada is so much behind that of the US, being that we're right next door. I don't know what it means in terms of growth. There just hasn't been a clear relationship in the past, and there isn't now, so you got me. At some point, maybe it'll mean something, but right now it just doesn't seem to matter. I'm not sure you've answered this before. How do you calculate the Fed hike cut probabilities? I gave you the link for it. Can you please comment on highs and lows on VXX over next quarter? I have no comment on that. I don't know. I've not looked at any of that. And how would I know what the highs and lows are over the next quarter, though? I mean, I guess I don't understand the question. What's the best way to pay copper? I already answered that one. I think FCX is probably the best way, but you can use COPX, which is an ETF. Considering the market is forward-looking, do you think it's possible the market is pricing in a mild recession, already looking past it? Well, the market, here is an asymmetric fact about market sentiment. And once you understand it, it becomes easy to understand why markets tend to want to push higher. I can tell you about stock ABC, and I can give you some kind of story about a promise that there's some future cash flows way in the future. That is enough to send the stock up. I can tell you about stock ABC, and I can tell you about a threat to cash flows that is sometime in the future. ABC won't go down. The threat must show up, and ABC will go down, but the promise just has to be spoken, and it will go up. So stocks tend to go up on optimism, but not down on pessimism. If you want stocks to really go down the way they go up on optimism, the threat must really show up. It cannot just be a promised threat, but you can promise future cash flows and a market will jump. So a company can announce that, we're going to be generating billions of dollars of cash flows in about 6 years, and that stock will run. And then you could say, listen, earnings are 220, they're going to come down to 200. And most people could probably say, yeah, that seems reasonable. But stocks won't go down until earnings actually go down to 200. That's just an asymmetric thing about the market. That is why markets do this, but do this. Because this is the promise. It'll go up on promise, but shit actually has to show up for the market to go down. That's why we say it takes an escalator up and an elevator down, because the market just doesn't want to seem to go down on just the threat of bad news. Bad news must actually show up. So it was very clear, and most people agreed, that if you raise rates high enough, you'll break something. But markets still went up until something actually broke. then it went down. And then we think, oh, it's all solved. It's all gone now. And most in the market would say, not really. There's going to be some lingering effects. It's not done. But it must actually break again for the market to go down. It has to actually break. So pessimism must actually happen, but it's enough just to have a whiff of optimism and the market will go up. So is the market pricing in a mild recession, already looking past it? Yeah. It's not, and it could not even be that. It's probably more realistic to say the market is just not going to price in bad news that when it shows up, everyone will say, see, I told you it was going to happen, but that nobody priced it in. So let's see. I know this question comes a bit, I already answered that one. What do you usually mean by introducing slack in the labor market? Higher unemployment or a higher participation rate. If you get a higher participation rate, you can get higher unemployment without anybody losing their job. Just more people coming into the labor market who want a job. Already answered this one. Talking about China, it's just not a country that you can forecast. Plus, it's not a freely floating currency. Where do you get 52, 26, and 13 IVB statistics from? Click on that little gear icon in the corner of the options chain window, and you have a whole bunch of different menu items. There's one of them on volatility, and then you have this long menu over here. You can select IVP, and you have the move. Just click move, and it'll move it into this middle panel, and then you have the apply button, and you're done. I'm going through it quick because once you open up the window, it'll really be obvious what to click on. Today's Jefferson speech. Banks have demonstrated, in the absence of stress, some reluctance to borrow from the discount window. That is common. Banks will use it as a last resort because they don't want anybody looking. That's the whole point, right? When you go to the discount window, you start to raise eyebrows. And maybe they don't want anybody coming by and going, should we have a look at something? What's going on? And they don't want that rumor getting out in the marketplace. It's the bank so-and-so had to use the discount window. They don't want to do that. They are concerned that borrowing from the Fed may indicate the bank is unable to borrow from other financial institutions, which is true. That's why it's called the lender of last resort. It's your last resort. That's why you go there. Sends a negative signal. Yes, it does. Why isn't everybody all running for the exits? Or is it okay during stress? Also, is it possible to see who specifically is using the discount window and how much? That's a good question. I don't know. I've never really checked to see who's using the discount window. I think it's... I really don't know. I don't know if that's published information or if that's just private information between the Fed and the bank at the discount window. But you can see that somebody's using it, but you probably don't know who. I don't know. Maybe somebody else knows the answer to that. What is the bull case for SPY? What will cause you to cover your short? Well, recessions have very clear footprints. Is you've got 1 or 2 quarters of heavy selling where the market just keeps going down. And then you'll have a point where it just seems like it's gone way too far and you think, okay, come on, we got to be done by now. When you're starting to feel like it's just too much, it's done. At least for me, that's always been my experience, that when the market is going up and I'm short, I'm okay with it, but sometimes it goes up like it did during the Fed press conference where I think, oh, come on, like this is ridiculous now. That's when I know it's a bigger short. And when the market is dropping and dropping and dropping, and I think, okay, well, this is a little much now, then I know that, I know for me that it's ready to go back in. But I'd need something to break, and I'd need enough selling in response to that thing breaking to justify going in. The big thing is I need to see a central bank cutting rates very quickly on the short end. I need to see them dropping rates fast. Then it's time to get in because I know the central bank is behind me and they got my back at that point. Let's see. Can you go over your futures options trade reasoning again slowly? Okay, I've already explained that one. That is why I used the June with the September underlying. How many agency shares? Okay, I already answered that. Why are you planning to go long pesos if there's a recession? I'm not. I'm planning to go long pesos after there is a recession. That's a long one, eh? This one's about social issues that you've mentioned, especially taxation. I'm assuming you are okay with basic welfare programs. I imagine you are commenting more on social issues in Canada than the States normally, but in the States, don't you think the economy would benefit in the long term from more socialist policies? Oh, I can stop there. No. That's a hard no. There's no point in reading the rest. I think you're trying to justify. It seems to me like consensus that generations of slavery... Oh, okay, we're going into wokest stuff. Okay, the answer to that is just absolutely not. No, I don't think it would benefit from having socialist policies at all. At all. In fact, it would devolve into more poverty, more crime, more grief. And that is just the history, the empirical, observable history of every country that started moving towards socialism. Every single country. There's not been a single example of a successful socialist country or a successful communist country in the history of the world. Not once. It is the quickest destroyer of wealth. It is the quickest destroyer of social mobility. It is the quickest destroyer of innovation. But if you're looking for equality and equality of outcome, socialism is fantastic, because everybody will be equal when they're all equally poor and equally miserable. Then you'll have equality. But what a terrible way to go. So I can answer that quickly. No. Hard no. I think that's it, eh? Yep, that's it. Okay.